Talk about the big pictures. Of course, the micro story has kind of usurped the conversation from the economic and macro one. Joining me, Collin Martin, Director and Fixed Income Strategist, alongside Liz Ann Sonders, Chief Investment Strategist at the Schwab Center for Financial Research. Part two of our convo, Liz Ann. One thing I'm looking at today is when you break down by factor what's leading this market. Of course, momentum's up top. You've got growth stocks, but the category that you've talked about the last year, high quality, is right there in the mix, just about a percentage point below. So is that where we should stick with instead of trying to chase all this Momo stuff?
Yeah, well, what's interesting is that where momentum lies is also where there is quality. And that's one of the benefits of, even though there's concentration risk associated with what we've seen, there's a little bit less of it. And a lot of the big winners, at least some subset of things like the Magnificent Seven, are doing well, not just because it's a momentum rally and valuations are getting stretched and it's just a bunch of euphoria and hype and chasing. When you look at quality factors like strength of balance sheet and strong cash flows and interest coverage, obviously, visibility in terms of profitability and the outlook for earnings, that's where you find them in a lot of these mega cap names. So there is that fundamental underpinning that I think is one of the distinctions relative to a period like 1999.
So we kind of get a little everything. You're not super levered to the momentum trade where you're in high quality, but you're getting a good amount of it to still have a big gainful sessions like we are today. So it seems like it's still a kind of sweet spot because it's beating value too.
For now, it's a sweet spot. On traditional value metrics like multiples, fairly rich, but there is an earnings stream. There's underlying earnings, and I think there's a better possibility at this point that earnings can grow into multiples versus the kind of implosion that happened circa 2000, where many of the companies that were the momentum drivers had no profitability, had no prospects for profitability, another important differentiator relative to that time.
For sure, very important, even compared to the COVID like SPAC mania, right? That blew up real hard and eventually was enough to kind of drag a lot. This time, one explanation is that we're just chasing earnings. So we're going where the money deserves it, punishing companies that cut dividends and stuff. Collin, what do you think about the bond market's response today to what seemed to be an overall pretty good basket of data?
Overall, it was pretty good. We saw yields, they're up for the day. They kind of wavered a little bit. We saw them drop a little bit earlier in the day following that S&P PMI services that came in a little below expectations, but now they're back up. I think a key theme that's been driving the market lately is the idea that the Fed might not cut rates as soon as the markets have been expecting. We basically got that in the release of the Fed minutes yesterday. And that's consistent with most of the comments that we've heard from various Fed officials. We got that today from two officials, and it's like they're almost using the same language, and they're talking about the risk of cutting too soon. So I think this is the way that the Fed is trying to tell the markets, back up those expectations a little bit. If we go back to the end of last year and into early this year, the markets were pricing in 5 or 6 rate cuts, even though the economy was still chugging along. So I think this is the way that the Fed is kind of pushing back a little bit, especially with those hot inflation readings, that let us wait and see how things are evolving first. And if we don't see inflation or the disinflationary trend continue, maybe those rate cuts get pushed back a little bit, and that supports the case for higher yields right now.
Okay. One of the things I heard from bond bulls and doves coming into this year when recession risk seemed higher, or when we had some of those regional bank scares, was that even if the Fed pushes back cuts, there's not going to be enough economic strength to kind of drive the train for too long. It seems like now with stocks blasting off to records, the data and the surprising to the upside still, it would kind of up those economic possibilities of strength. Should we be revising our expectations for what's possible for the yields too?
Well, we haven't revised ours just yet, Oliver,
Okay.
but I think that's a really interesting point. If you look at the structure of the yield curve and why the yield curve is inverted right now, it's based on expectations for what the Fed will or won't do over the next number of years. For yields to keep rising, you'd have to have the expectation that the Fed is either going to hold for a much longer period of time or that they'll actually resume hiking. As long as the next move is expected to be a cut, we'd expect to see that yield curve inverted for now. So you'd really need to see an acceleration in growth and inflation that would warrant that aggressive response from the Fed to begin to re-up that hiking cycle. So if we look at what's the upside for Treasury yields, sure, they can go up a little bit from here. We still think the peak is behind us. We don't expect the 10-year Treasury yield to get back to that 5% level. But the longer that the Fed holds, that does allow some room for them to drift a little bit higher in the short run.
Okay, all right, great stuff. Like that detail. Liz Ann, as we think about what's next on the calendar, tomorrow's empty as far as economic data goes. Inflation, I guess, our next big highlight. What are you looking for to move the needle next for markets?
Yeah, so PCE doesn't tend to surprise in a significant way, either above or below expectations, only because the components of PCE you get via CPI and PPI. But I think in this environment, even a slight shift in direction relative to consensus could be a needle mover. We saw much better claims today. So in addition to the upcoming jobs report, we still have to wait a little bit. I think the weekly data on the labor market are important. And then, of course, we get the first revision to fourth quarter GDP, and we'll have to see whether that moves in favor of what has been more hawkish commentary from the Fed lately.
All right. Yeah, that'll be a big one now to watch those GDP revisions. Sometimes they get ignored. I don't think they're going to this time around. Thanks, Liz Ann. Thanks, Collin. Great convo, guys.
Thanks.
Excellent way to finish the day here. Collin Martin, Liz Ann Sonders coming up.